Hey everyone, it's Imran back with another macro option spotlight. Okay, so fast money looks like they were lightening up a bit last week. Obviously, we saw stocks lower, um, and we did see the largest outflow in tech in 10 weeks, according to Bank of America's flow data. However, we know that we've seen retail has been buying in bigger size, bigger clips than they have recently. So I think retail is still in buy the dip mode. Systematic players such as Vol Control and CTAs, commodity trading advisors, they've been adding exposure all year. You can see that from the charts. So if we have a look, CTAs looking pretty long. Potentially, if the market goes down, they are going to need to sell. So there's some trigger points. About 100 points lower on the S&P apparently are some trigger points for CTAs to be selling. And then vol control, the way that works, you can see here this blue line just been rising all year, and it's all about volatility. So if realized volatility drops down, then what that means is these vol control guys need to add exposure to equities because it's a less volatile asset, so they can afford to leverage their book to a greater extent. So as vol goes down, vol control has to add exposure to equities, which is what we've seen. So it's basically this line going up here. And if realized vol picks up, then they have to de-risk and they have to sell some equities. So given that positioning is pretty much at the highs of the year, and vols are at the lows of the year, there's plenty of room if vols were to have a bounce for these guys to come and sell, 10, 20 billion, whatever dollars of exposure they need to sell. So that's something we need to be aware of is a potential risk out there in the market. Now, given the explosive run up that we've had from 42.50 in the S&P since that level was broken to the upside, we do think a consolidation down to the 4,300 area into month end is pretty healthy. And we also think it will be a well-supported pullback just because the volatility moves we saw last week in the surface showed us that the street is not wanting for gamma, right, or vol. So the street is happy to sell vol at the lower levels as we've gone down, which suggests that they will probably be supporting the market because their gamma positions will then lead them to need to buy delta if the market drops 1 or 2% from here. So we think that's going to be supportive into the end of June, into the end of this week. But if we were to get below 42.50, we think that positioning landscape can shift pretty quickly. So you'd want to have some stops down there below 42.50, 4200, because then once we get away from that long gamma position that the street has got, there is then room for the markets to move a bit more and be less supported. So that's the kind of trapdoor area we probably need to look out for. Okay. So if you are going to buy the dip into any sell-off into the end of this week, be careful that you do put some stops in place in that zone where we think dealers are going to run out of their long exposure. But we do think a decent clip is being supplied to the street on Friday in September options through this JP Morgan roll. So that is going to be a net sell of Vega, but we think the street to some extent is front running that, and that is why the vol has been so well offered. Okay, moving over to our dashboard. S&P stocks in general had a rough week. We're tracing some of the exuberance of that June OPEC squeeze that we saw, where the S&P got very close to 4,500. We do think there's probably more selling to come this week with quarter-end rebalancing flows and things like that, keeping a lid on stocks. But we do think there's dip buyers waiting in the wings, so we don't think this is about to turn into anything too sinister. Europe and Asian stocks did also underperform. Europe had some pretty poor PMI data out of France and Germany. Market didn't really like that. Euro took a walloping on that as well. And then China seems to be underwhelming on stimulus efforts. And so stocks there were down 7% as well last week. The dollar did firm a bit. Commodities didn't like that. For the most part, nat gas was the only one rallying. All the other commodities were softer. And the yield curve continues to bear flatten, right? So as we got surprise hikes, 50 pip hikes out of the Bank of England and Norway, we saw the front end of the yield curves go a little bit higher, but those back ends are still yield-wise are still coming down. So that bear flattening continues to happen. Skew-wise, we saw equity skew bouncing from recent lows, but it still does remain pretty depressed. Clearly, we had a lot of call volume on that explosion higher a couple of weeks ago, and that has kind of changed the balance within markets somewhat. Put skew rising in commodities as well with the spot weakness that we've been seeing. And then dollar upside also seeing a small uptick and bond skew drifting lower. Implied vols softer in the US on the way down. We do think there's lots of supply around at the moment, certainly in these local strikes, and that's likely to continue into month end. European vols were better bid though. The sell-off was, in terms of vol adjusted terms, it was almost double what we saw in the US. So a bigger sell-off in Europe, some soft data in Europe and things like that, leading to a pickup in volatility, where that front end European vol's back on a 13 handle, whereas the S&P is still on a 10 handle. Okay, so it makes a change that we see that, but that uptick in vol there in Europe, taking European vols higher. And then we do see positive carry in Europe because those implied vols have gone up, whereas implied vols in US have not gone up, which is keeping that carry negative in the S&P. Speaking of carry, generally it's pretty mixed. Many implied vols are very low. You look at the likes of HYG on a 6 handle. You look at all these major currencies on a 5 or 6 handle. It makes it hard to sell gamma profitably when vol's at 6, basically, right? It doesn't need to do much to take your theta away, as risk premium is just non-existent right now. There are some pockets of positive carry that still exist, as we mentioned, European index, and there's some stuff within the sector space, which we'll talk a bit more about, but that's kind of where the positive carry seems to be residing right now. Okay, so moving on. So hunting for carry in a low vol world, right? That's kind of what we're all doing right now. In low vol environments, it doesn't feel good to sell gamma psychologically because implied vols are at the bottom of the range, and because vol is a bit of a mean reverting asset, you don't feel like it's a smart trade to sell it at the lows. However, if markets remain range bound like they've been for months, then earning theta is normally the right trade, whereas buying options is a recipe for losing money. Okay, so you tend to need to have some sort of positive carry in the book to navigate these type of environments, and these environments can last for months, if not most of the year, right? So you definitely want to be careful of just bleeding the whole year. Now we use our vol dashboard to help flag where the positive carry opportunities are showing up, and then we use our own discretion to determine if we think markets are able to stay in a range for a period of, say, 2 to 4 weeks generally, right? That's going to be, we're not going to try and look too far ahead and determine what's going to happen for the next 3 to 6 months. But if we've got confidence that a market is kind of likely to stay in a range for 2 to 4 weeks, then it gives us the appetite to put on some sort of carry position. Okay. Now, ARK is a good example here of one of these candidates because it got to the top of the range where it was threatening to break out. And if it broke out, we saw it could charge easily another 10% pretty quickly. However, that breakout was rejected from that previous resistance zone. And now we are back right in the middle of the range that we've been in for about 6 weeks. So now we think ARK's actually a prime candidate to stay relatively range bound here. And then if we look at our vol dashboard, it kind of shows us that the carry is positive in ARK as well. Okay. So but the problem is, looking at the dashboard, you can see that the strategy compass is never going to tell you to be selling vol in this asset when vols are at the lows of the range, right? Vols are very low, spots a bit range bound in the middle, but vols are low, skews very low as well. Term structure is kind of very slight contango. So what do? So the way we like to sell carry and keep ourselves safe and be somewhat agnostic to the fact that vol might be at the lows, whether vol's at the high or the lows, okay, is by doing iron condors. All right, anyway, that's it for today. Thanks a lot for listening, guys, and I will check you out tomorrow.